Happy evening to all of you for taking your time to come and join us. So this is a joint session organized by PurplePond Investment Advisory Private Limited along with Kotak Mahindra Asset Management Company. Now I take the opportunity to introduce Mr. Nilesh Shah, who is our speaker today. I am extremely happy to introduce you, sir. So Mr. Nilesh Shah is the Managing Director of Kotak Mahindra Asset Management Company. He has over 25 years of experience in capital markets and market-related investments, having managed funds across equity, fixed income securities, and real estate for local and global investors. In his previous assignments, he was involved with Axis Capital, ICICI Prudential, Asset Management Company, Franklin Templeton, and ICICI Securities. He is a recipient of inaugural Business Standard Fund Manager of the Year Award for debt in year 2004. He's part of the team that received the Best Fund House of the Year Award for, while working at Franklin and also while at ICICI Prudential. He's a gold medalist in both chartered accountant and also a merit ranking cost accountant. His hobbies include educating investors. You can see that's why he's here today to talk to you on financial planning. And he has co-authored a book on financial planning called A Direct Take. He has been appointed as the new chairman of AMFI, which is the body which takes care of supervisory body for mutual funds. And he is also a part of Prime Minister Narendra Modi's Economic Advisory Council. And above all, what I like about him personally is a very articulate and well-informed speaker. So I will not stand between the speaker and all of you. So welcome Nilesh Bhai, the floor is yours and we look forward to receiving the pearls of wisdom from you.
Thank you, Ishwar, and very good evening to all of you. We are living in one of the toughest, challenging period. There was a movie of George Clooney called Perfect Storm, where a fisherman takes his boat to a place where 3-4 storms were converging. That is Indian and global economy today. A medical crisis erupted in China, shut down economic activities around the world, and shut businesses, created financial crisis. Now all over the world, everyone is facing a medical crisis, economic crisis, and financial crisis together. Almost 100 days have passed since India came face to face with this medical crisis, and following observations are available on economy. One, Bharat or rural India is doing better than urban India. Fertilizer sales in May were 98% higher than last May. Rabi crop output was 10 million ton higher than advance estimate. Kharif season sowing is 39% higher than last year compared as on 12th of June. CV sale, the tractor sales and two-wheeler sales and cement sales are fast reaching normalization level in the last week of June, and it could be even higher than last year in the first week of July. So it will be fair to say that rural India this year will post positive growth. Urban India is trying to come to normalcy, but it is facing challenges. If we look at petrol consumption, it was up 11% in Feb. It fell 60% in April. And in first half of June, it was down 18%. So reasonably good recovery from bottom of April, but it is still long way before we can reach Feb level. The toll collection in February, daily toll collection was about 64 crores. In April, it came down to 8.3 crores. In the last week of June, it averaged 52.1 crore. So from 8.3 crore to 52.1 crore, great recovery. But to go to 63.5 in Feb, it will take some time. E-way bill generation was 57.2 million in Feb, fell to 8.6 million in April, came back to 40 million in June. It's a good recovery from April to June, from 8 to 40, but to reach to 57.2, it will take some time. The mood of the economy is measured in GST collection. In April, it was 32,000 crore. May was 62,000 crore. And it's 91,000 crore in June. Effectively, if we see rural economy should post positive growth, urban economy will post negative growth, And today market is factoring in that Indian economy will degrow by about 5% for the first time since 1980. Now the real question for investors is that if economy is doing so badly, how come market is doing so well? Well, in reality, when you are looking at market, you are looking at two compartments, a good performing stocks and bad performing stocks. On 30th June, plain reading Nifty suggested 10,302 Nifty. But 15 stocks like Nestle, Lever, Asian Paints were trading at 13,890 level. The other 35 stocks like Tisco, Hindalco, Tata Motors were trading at 7,498 level. 15 stocks have pulled the market up, and which is where we are seeing index at 10,302. Similarly, in large cap, mid cap, small cap, compared to 2017 level, large caps are down 2%, mid caps are down 30%, small caps are down 49%. If we look at in terms of historical levels, large cap today is available at 3-year before prices. It's trading at 2017 level. Mid cap is available at 4-year before prices. It's trading at 2016 level. And small cap is trading at 9-year before prices. It's available at 2011 level. Certainly, markets is sharply polarized. Few stocks have done well, pulled the index up. Others haven't done as well, pulled the market down. Now, if we have seen Z Group shares, penny stocks, they have done very well in last 2-3 months. Some stocks are up 1,000%. In penny stocks, when money comes, returns are fairly good, but we know it's like holding ice. It continues to melt after a period of time. So our recommendation is buy quality, avoid penny stocks. Those are too riskier bets to make money on a sustainable basis. Next question then comes, Nilesh, how do we make investment in this market? Today, P ratio is a bit difficult to calculate. Nifty earning estimate for FY20 was 678 in the beginning. It came at 463 rupees. It was 769 for FY21 in the beginning. It is now expected at 445 rupees, lower than FY20. FY22, obviously, people are hopeful and they're still putting 600 plus Nifty earning for FY22. But clearly, there is uncertainty on FY21 earnings, and hence calculating P ratio will not be advisable. What we'll recommend you is to calculate market cap to GDP ratio. On 17th of Jan at 12,000 Nifty, market cap to GDP ratio was 78%. On 23rd of March at 7,600 Nifty, market cap to GDP ratio was 51%. Today, as we speak, market cap to GDP ratio is 71%. If market cap to GDP ratio moves substantially below its long-term average of 73%, it's time to add more equity. If it's nearer to 73% like today, it is time to be marginal overweight or just neutral weight to equity. Assume that a gentleman wants to put 60% in equity. Today, his portfolio allocation will be anywhere between 60 to 65%, not more. But on 23rd of March, when markets had fallen to 7,600 Nifty and market cap to GDP ratio was 51%, his allocation to equity would have been as high as 80%. Now, obviously at 7,600, you can't move from 50 to 80 or 65 to 80. You would have bought something at 9,000 Nifty, something at 8,500, something at 8,000, something at 7,500 also. By averaging yourself into the market, as market cap to GDP ratio keeps on moving farther, you will be able to average yourself into the market. The second question then comes, should we buy mid cap, should we buy small cap, should we buy large cap? Well, normally large cap moves first post correction. This time, large and mid cap seems to be moving almost parallelly. Our feeling is that if you're a conservative investor, go for large cap stocks or large cap funds like Kotak Blue Chip. If you are average investor, go for multi-cap funds like Kotak Standard Multi-Cap. And if you are aggressive investors, go for high risk, high return fund like mid-cap fund, Kotak Emerging Equity, or small cap fund, Kotak Small Cap Fund, or focused fund, Kotak Focused Equity. Try to invest based on your risk profile. That will be more appropriate. One question then comes, should we put money lump sum? Our request is no. Market can swing how event shapes up. If there is early medical solution, tomorrow vaccine gets discovered, which is unlikely, but I'm just making a statement, markets will be higher. If potential 8 vaccines which are in phase 3 trial, market has put a hope on the same, they all fail, markets will certainly correct. Depending upon how the future events will be, markets can swing positively or negatively. And keeping that in mind, we believe it is time to invest on a systematic transfer basis in multiple tranches rather than at one go. One question comes that should we be investing in SIP? SIP returns have been pathetic. For 5-year period, SIP returns are below FT and PPF. What should we be doing? Well, I'll just give example from my own equity fund, Kotak Emerging Equity. The 5-year return of Kotak Emerging Equity is 11%. This was on January 20. The same return became minus 4% in the month of March when markets corrected. In June, markets have rebounded a little and returns are already positive 2%. If index continues to rise further, will this returns go back to double digit? Answer is yes. What looked plus 11 on a 5-year basis was 17% on a 10-year basis. It came down from 17 to 9 in the month of March for a 10-year SIP in Kotak Emerging Equity. It is back to 12% return in the month of June as markets rebounded. As your period of investment increases, the volatility in SIP returns will decrease from 17 to 9 to positive 12 on a 10-year SIP in just about 4 months illustrates how SIP returns fluctuate. In a bear market, SIP returns are lower than PPF, lower than bank FD. In a bull market, they deliver multiple times bank deposits or PPF or FD return. My request will be, unless you have financial emergency, please continue your SIP. What you are buying today will give you most handsome return when markets recover. Next question then comes, apart from equity, what other asset class we should look at? Well, gold is something which one should consider. Gold prices does very well when interest rates are low and liquidity is high. In the period of September 2008 to September 2011, gold prices moved nearly from $750 to $1,900. This was possible due to low interest rates and high liquidity. The same scenario is likely to replicate in today's time. Gold has already moved from $1,450 to $1,800, but going forward, it could rise even further. Gold can be bought physically or gold ETF or gold bonds. When you buy gold bonds of Government of India, you get coupon income over and above gold price appreciation. Gold ETF, you have to invest by paying fees. We charge expenses, but compared to gold bond, we provide daily liquidity. If you are intending to buy physical gold, be sure that you have got the right quality. And more importantly, you must remember that you are paying a significant premium when buying gold in smaller denomination. If you buy a gold coin from a bank and sell it to a jeweler in a smaller denomination of 1 gram, 5 gram, 10 gram, you're bound to lose between 15 to 30% of your investment, as banks charge that kind of premium by distributing gold. Overall, gold does look attractive from a long-term investment point of view. Do remember that in India, gold carries import duty. What was $100 of gold in Dubai is worth $112.50 because of 12.5% import duty. If that import duty gets reduced, gold returns will come down. But if you are taking a longer term call, you need to be willing to take that risk. Coming to fixed income funds, Franklin Templeton's winding of 6 schemes created flutter in the market. Media is going hammer and tong saying that investors are moving away from debt fund. And there is a lot of confusion. Let me try to bring some facts in front of you. Despite media's continuous hammering that investors are losing faith in debt funds have continued to receive flows. In April, they got 43,000 crore. May, they got 60,000 crore net inflow. And June, excluding overnight and liquid fund, they got 48,000 crore of inflow. So please remove this myth from your mind that investors are losing faith on debt fund. They are continuing to remain invested. Second, when Franklin Templeton announced winding of six schemes, it was related to issues for that firm. Others continued doing their business on a normal basis. In 2008 also, one fund who faced pressure had to shut down their liquid funds redemption, but others continued doing their business like normal. The same thing is repeating in 2020. Other mutual funds have carried their business normally, while Templeton had to announce winding of 6 schemes. We believe if you look at our portfolios and then take decision, you'll prefer to remain invested, including in our credit risk fund. People who panic and redeem in the month of April ended up paying short-term capital gain tax of 30% plus on their capital gain. They also paid a heavy price because post their redemption, May and June, this credit risk funds have delivered between 3 to 4% absolute return. Clearly, there's no point in following WhatsApp warriors and social media gurus. It's far better to consult your trusted advisor like PurplePond to get the comfort that your investment is in right path. In the fixed income space, if you are willing to take risk, you can afford to take 1 or 2 knockouts, then credit risk fund is appropriate. There will be credit events going forward, but if you take a 3-year view, the negative impact of such credit events will be minimal and you should be able to generate decent return. If you don't want to take credit risk, then corporate bond fund or dynamic bond fund or short-term bond fund will be appropriate. This fund manages risk and interest rate in a reasonable fashion to generate positive return. If I have to summarize, this is the most unprecedented time we are facing. We cannot say market or economy has bottomed out till such time we get medical solution. In absence of medical solution, markets will swing between positivity and negativity. Look at market cap to GDP ratio to increase or decrease your investment in equity. More market cap to GDP ratio is in line with historical averages. You should be neutral weight to equity. Farther it is away from historical average, you should be overweight equity. Small, mid, large, all provide an attractive opportunity, provided you are investing looking at your risk profile. In the fixed income space, what happened with Templeton is an isolated event. Others have continued doing their business and hopefully they will continue to do their business going forward. Gold ETF also provides an excellent investment opportunity, keeping in mind 2 risks. That one, import duty is very high. If import duty gets reduced, there will be negative impact on return. Second, gold bonds give coupon income plus gold price appreciation, but limited liquidity. Gold ETF provides daily liquidity, but they also charge fees for providing such facility. This is how you should be looking at today's investment world. Happy to take your questions.